So I want to get right to the inflation question with you, sir. It hit the bond market again today. It put a cap on stocks again today. I know you think maybe the dollar has peaked, but it looks like the signals from inflation itself and from the Fed and from the ECB even now is more rate hikes, maybe bigger ones, until inflation starts coming down.
It's pretty much a given that rate hikes are coming and the Fed will move in 50 basis point increments, and even the ECB themselves might kick off with a 50 basis point move. But in terms of inflation, it hasn't peaked yet in Europe because Europe is facing much more severe inflationary impulse as a result of the soaring energy prices that they have to pay. But for the US, there are increasing signs that inflation, at least from a headline year-on-year basis, has peaked. And we expect that to gradually come off. Now, it'll still be above the Fed's target, but at least it's moving in the right direction. And, that's part of the reason why I think the dollar is pretty much peaked, because, while the Fed is committed to delivering at least 2, maybe 3 more 50 basis point hikes, pretty much all of that is already priced in. And therefore, I believe we have pretty much passed peak Fed hawkishness. And as long as the Fed just delivers what they have signaled, that's not going to be supportive for the dollar, in my view.
Okay. What about the recession fears? We know that some of the Fed officials like Raphael Bostic have said we can't be reckless. The door is open really to go do more and get more aggressive or do less. But recession is what I think sometimes some people say is bad for stocks. If there is a recession, some people say it's good because then you sort of start pricing in the recovery and stocks can rally.
Well, our baseline case is we don't see a recession in the U.S., but of course markets are increasingly worried about the possibility of one. Now, if the U.S. were to go into a recession or a hard landing, initially, obviously, that's going to be very negative for risk assets, and stocks definitely have further downward to go. And while we flirted with bear market territory on the S&P, if there are genuine signals that the U.S. is heading into recession, then we'll be back into bear market territory before we know it. We will most definitely get a short-term spike in the U.S. dollar. That's what tends to happen in the initial stages of a recession. But pretty soon after that, the Fed will pivot, and that will be the catalyst for the dollar to then resume its slide. And eventually, once we get close to the bottom of the recession, that's when the signal is for risk assets to start rallying again.
As we see U.S. yields surging, does that sort of put a cap on the recovery that we've seen in the yen? Because we have seen that return of both the yen and the Swissy in terms of finally kind of catching up with the haven demand for the dollar.
But the yen is pretty much moving in line with yield differentials between U.S. Treasuries and JGBs. And with the BOJ firmly committed to the yield curve cap of 0.25% on the 10-year, it's really where the U.S. 10-year goes that will determine how dollar-yen moves. And, yes, when risk assets were under pressure, we did see a little bit of a relief rally in the yen, but the yen really isn't as strong a safe haven as it was in the past. Now, if U.S. yields were to continue to march higher, then certainly we'll see, dollar yen heading past 130, and further higher. But it looks increasingly likely that perhaps, we are starting to reach a top in terms of where U.S. 10-year yields will go. And if that's the case, then it's hard to see dollar yen pushing much further higher. So I think we'll probably range trade in dollar yen. From here, I see a 127 to probably a 130 range in the coming months.
The fact that we continue to see the slump in forward points for the yuan, does that tell us that there's still quite a lot of pessimism over the state of the economic recovery?
Well, the market is certainly still somewhat pessimistic and still believing that the yuan will continue to weaken. I'm pretty much not of that view. I believe the yuan can recover and indeed will rally into year-end. I have my year-end target of 6.50, and my reasoning is quite simple. Yes, the Chinese economy has had a very challenging period in the last couple of months with the lockdown in Shanghai and all the challenges that entail. But we're starting to see restrictions ease off, from this month. We're already starting to see a rebound in economic activity, and I think the better than expected PMI numbers yesterday, a test attest to that. And the unofficial PMI numbers coming out later this week will, further provide confirmation of that. And as long as China can continue to ensure that outbreaks are contained, we'll see quite a decent rebound in Chinese economic activity in the coming months due to all the stimulus measures that are being put in. And that's going to propel a relief rally in the yuan, in my view.
Where do you sit when it comes to growth expectations for this year? We've seen as low as 3%, possibly even a little bit lower against that target, which clearly most people, if not all, are not expecting to be met.
I think it's very clear it's increasingly difficult to meet the 5.5% growth target for this year. But I think it's still possible for China to hit maybe a 4.5 to perhaps a 5 range, provided that all the stimulus tools that they've employed really gets deployed, and as long as they can ensure that there are no further outbreaks or lockdowns, particularly in major economic hubs like Shanghai, then I think it is very achievable. We'll see a very, very strong rebound in the second half of this year.
So now you said you downgraded your forecast for year-end for the Aussie dollar, New Zealand dollar, other Asian currencies forecasts because of slower global growth, tighter financial conditions, China's COVID strategy. Do you still feel that way? We're waiting for those South Korean export numbers later in our shows. China's a pretty important driver.
China is a very important driver, and export numbers will reflect the partial lockdowns that had occurred. But, with these restrictions easing and now with the ports in Shanghai pretty much back to full capacity, we should see those export numbers, start to recover. So let's not forget some of the export numbers and economic data coming out from Asia is still being impacted by the lockdown in Shanghai. But now that we are cleared that, the upcoming months should see a meaningful bounce, and already we're seeing tentative signs of that coming up from the Chinese data yesterday.